Hi, welcome to chapter 14. Obviously my favorite chapter. Why? Because I'm a professional accountant. It's what I did for over 20 years. So that's what we're going to talk about here, a little bit about accounting. So our learning objectives for today demonstrate the role that accounting and financial information play for a business and its stakeholders, list the steps in the accounting cycle, distinguish between accounting and bookkeeping, and explain how computers are used in accounting. Big time. Explain how the major financial statements differ and identify the different disciplines within the accounting profession. So what is accounting? If I ask my students, typically when I ask my financial accounting classes, they more often than not come up with bookkeeping descriptions for accounting. But accounting is not bookkeeping. Bookkeeping is the recording of the transactions and the keeping of the records and creating the financial statements. Accounting is that plus making sense of the financial statements and using the information to make decisions on how to manage the business better. So accounting keeps track of transactions, buying and selling goods and services, getting insurance, paying rent, all these sorts of things that keep the business going. Outside parties, such as employees, owners, creditors, unions, investors, and the government, make use of accounting information. They're known in the industry as stakeholders, people or institutions that have a direct impact on the business and have a stake in the business keeping in business, staying going forward. Accountants have to follow what are called GAAP, generally accepted accounting principles. All American companies must follow GAAP. So here's the accounting system in a nutshell. So we have inputs. Those are the original documents of entry. So sales documents, purchase documents, checks, payroll records, that sort of thing. Then comes the processing part. Entries are made into journals. So recording is made of the transactions. The effect of the journal entries is posted into ledgers. So we have a general journal that's chronological. It's easy to put in entries into it because they're just one after another as they happen in time. The general ledgers take those entries and separate them by type. We call them accounts, and that way we can see what's happening to the business more clearly. The outputs from this processing are called the financial statements. They're nothing more than formalized reports, and there are several of them. There's the balance sheet, the income statement, the statement of cash flows. So here's the bookkeeper's role. Bookkeepers divide a firm's transactions into meaningful categories. That's going into the ledgers that we talked about just previously. Double entry bookkeeping requires 2 entries for every transaction. Here are the steps in the accounting cycle. So we have source documents. We talked about them just previously. They're recorded in transactions in journals called journal entries. Those journal entries are then posted to ledger accounts. So that's where the accounts are summarized so we can better understand what's happening in the business. When we're finished at the end of a period, we add up the balances of all those ledger accounts, and that becomes what's called the trial balance. Once the trial balance is tied out, it makes sense, everything has been recorded accurately, we can then, from the trial balance, create the financial statements. Once the financial statements are prepared, we then go into the analysis phase where we take a look at all of the statements, we look at the numbers, we compare statements from prior periods, and we can see any discrepancies, we can see trends, and we can come up with ways to increase productivity, decrease costs, expenses, and increase the bottom line. Bookkeeper's role. The ledger is used to keep information about single accounts. That's what I was talking about. And then again, we go into the trial balance, which is essentially the ending balances of all the ledger accounts at the end of the accounting period, which for most companies is going to be the end of the year, December 31st. Computerized accounting programs post information instantly. It used to be with manual books, you had the general journal, and then you had to manually move those journal entries into ledger accounts, and then from ledger accounts onto the financial statements. That's now all done automatically with computers. So what computers have done is computers are doing a lot of the grunt work, right? The nitty-gritty accounting, so that accountants can spend more time analyzing the results rather than creating the reports. Financial statements indicate a firm's financial health and stability and are key, as I've said, key factors in management decision-making. The basic building block of accounting is called the accounting equation. And what it says is assets, which are all the things the company owns, equals liabilities, which are the things the company owes, O-W-E-S, plus the difference between these two, which is known as the owner's equity. That's the owner's investment in the business. The balance sheet is a financial statement that reports the firm's financial condition on a particular day. And it reports essentially the assets, liabilities, and the owner's equity. It tells us what does the company own, how much of what it owns was borrowed, and how much was from the owners. Assets, productive assets, tangible items such as equipment, buildings, land, furniture, motor vehicles, that sort of things the company owns. And there are also intangible items. There are assets that are not, you can't touch, taste, or smell, but they are still assets. Things like patents, trademarks, copyrights, and goodwill. Assets are listed on the balance sheet in the order of liquidity. The word liquidity means how easy is it to turn that asset into cash. 3 categories of assets. There are current, there are fixed, and there are intangible. Then there are liabilities. Liabilities are things that the company owns. Accounts payable. Those are bills that have not been paid yet. Accounts with vendors. There are notes payable. A note is a loan, so a note payable is a loan that needs to be paid. And then there are bonds payable. One of the ways that companies get cash in order to expand or buy new equipment is to sell bonds on the open market. And when they sell those bonds are held by the bondholders for a period of time, which is known as the, the word always escapes me. Bonds have a maturity date. There you go. When the bonds mature, the bond principal is paid back to the bondholder. While that principal is being held by the company, it is a payable, a liability, something that the company owes to the bondholders. Stockholders' equity is also called owner's equity. It's essentially assets minus liabilities, as it's said in the accounting equation. Now the phrase retained earnings, the word retained means to be held. Retained earnings are profits that have not been paid out to the owners and are being held for one reason or another. Maybe they're being held for reinvestment in the business. Maybe they're being held to hand out later on as dividends. The income statement is the big pop-up. The income statement shows profit or loss. That's where the proverbial bottom line comes from. It takes revenue, which is all of the resources that have been earned, subtracts all the expenses, the things that were incurred in order to create the revenue, and the difference is either going to be a net income if it's a positive number or a net loss if it's a negative number. So here's the formula for the income statement. We have revenue, cost of goods sold. That's the cost for a merchandising company like Amazon or Walmart. That's the cost of the goods that they have sold that created the revenue. The difference is called the gross profit or the gross margin. From that, we subtract the operating expenses. Those are all the expenses that are required in order to keep the business going, to, again, create that revenue, which gives us then a net income before taxes. We then calculate the taxes due, and we get net income or net loss. Revenue is the monetary value a firm received for goods sold, services rendered, or other payments. It's what the company is in business to do. It's not the same thing as sales. Cost of goods sold, as I mentioned before, that's the cost of the merchandise that created the revenue. Gross profit is the difference between the two. Operating expenses include rent, salaries, supplies, utilities. Depreciation. Depreciation is an expense for long-term assets. Like if I buy a truck, there is an expense for the truck, and according to accounting rules, I have to spread out that expense of the truck over the time I'm going to use it. So if I'm going to use it for 4 years, I have to spread that expense over 4 years. I can't recognize it all in 1 year. Statement of cash flows. So the income statement and the balance sheet are what we call accrued statements. They don't represent cash in, cash out. They represent earned revenue, whether or not it got paid yet, incurred expenses, whether or not they've been paid yet. The statement of cash flow says, here's where you got cash, here's where you spent cash. And cash, of course, is important to a business because without cash, it can't survive. You could have $1 million owed to you in accounts receivable, but if it doesn't get collected, you're going to go out of business next week. The statement of cash flows is divided into 3 major sections that are related to cash in the business: operations, investments, and financing. The difference between cash coming in and cash going out. That's what the statement of cash flows is all about. Managing cash flows is a key consideration for a business. Financial accounting generates financial information and analysis for people primarily outside the organization. Outside users are interested in these questions. Is the organization profitable? That comes from the income statement. Is it able to pay its bills? That's going to come from the balance sheet. How much debt does it owe? Again, that's going to come from the balance sheet. There's every corporation that sells stock, public corporation, has to have an annual report. It's essentially a statement of here's where the company was. These were the things that we accomplished last year. These are the expectations for this year, our goals for what we're going to do next year. And it includes the financial statements as well. Assembling a truck engine requires many tools, parts, raw materials, and other components, as well as labor costs. Keeping these costs at a minimum and setting realistic production schedules is critical to a business's survival. What other internal departments must management accountants team with to ensure company competitiveness? As a controller, I worked with all of the vice presidents in the different departments on the technical side of the house. I worked with the marketing department. I worked with sales. I worked with everybody because we all need to work together to come up with the proper numbers for planning for the future. Key things to watch for and read in an annual report. Management's discussion and analysis. That's the management telling you, here's what we did. Here's what happened last year. Obviously, the financial statements, the balance sheet, the income statement, and the statement of cash flows. And then there's an auditor's opinion. All public companies must have an audit of their books, which means that they hire accountants from outside the company, CPAs, certified public accountants, who come in and look at the way the numbers were recorded on the books. And the auditor will make an opinion as to whether or not the company followed generally accepted accounting principles. That's what's included in the annual report. The auditor will give basically, they'll give a grade to the way the company is doing their books. Accounting disciplines. There are private accountants, an accountant who works for a single firm, government agency, or nonprofit organization. That was my career. Public accountants, an accountant who provides accounting services to individuals or businesses on a fee basis. And then there are CPAs. CPAs are authorized to do certified audits, and audits are a big deal for public companies. Private companies, not so much. They don't need that. Sarbanes-Oxley. Sarbanes and Oxley were a senator and a congressman who in the early 2000s created the Sarbanes-Oxley Act in response to the problems with Enron and WorldCom and Tyco International, companies who falsified their financial statements. And Sarbanes-Oxley Act prohibits accounting firms from providing certain non-auditing work. There is a problem with CPA firms. Big CPA firms are not only providing auditing work, but they're also providing management consulting services. And with regards to Enron, that was a problem because the same company was doing both. And the things that the company was suggesting as a consultant were not according to accounting principles for the auditors. The big change here requires company CEOs and CFOs to certify the accuracy of financial reports and impart strict penalties for violation of securities reporting. So prior to Sarbanes-Oxley, the CEO and the CFO did not have to sign off on the financials at the end of the year. So therefore, if there was something wrong with those financials, they could simply say, well, we didn't know. Ways to improve accounting practices: create and expand internal audits. The big one, however, review and change current procedures, making sure that things are being tracked and done correctly. Managerial accounting, on the other hand, is an internal process, measuring and reporting costs of production, marketing, and other functions. Managerial accountants prepare budgets, checking whether or not units are staying within their budgets and designing strategies to minimize taxes. So managerial accountants work on the inside, financial account for the internal stakeholders. Financial accountants work for the external stakeholders. Auditing, I've already talked about. Tax accountants, accountants trained in tax law, excuse me, and responsible for preparing tax returns or developing tax strategies. Government and nonprofit accountants, accounting system for organizations whose purpose is serving ratepayers, taxpayers, and others according to a duly approved budget. And then there are generally or government accounting standards board, separate from the CPA side. And that takes care of our very brief discussion of accounting. Please let me know if you have any questions. I'm here for you.